Hey everybody, Mark here at TSLA, and happy to say that Tesla closed in the green today. The closing price was $238.59, which was a share price increase of $8.55, or in percentage terms, that is 3.72. And as you can see on the chart, I drew some lines to reflect what a pattern that we could track could be. Originally, we thought this was a cup and handle, right? We thought it would be, okay, here's your large cup, and we made an equal high, and then we got to this point where there was this smaller kind of cup, which is really the handle of the cup and handle. And unfortunately, that next day it sold off dramatically. But now as we're seeing price develop, what we're seeing is higher lows being put in. I drew a diagonal line, this trend line here. That kind of gives you an idea of what the higher lows are looking like. And we are also seeing equal highs being made. So we're really pressing up against the 240. Now, in an organic situation with so much more organic context, meaning that regardless of Jackson Hole and what have you, today is Friday, right? So Friday we have expirations on Tesla's options and all the other options on single tickers, especially. So there was much more motivation to keep the price under a manageable strike. They kind of conceded the 235 pretty quickly. We broke through that. And they really wanted to get the price below 237.50, which was the other strike that they're willing to go with, the market that is. But there was buyers that kept it above the 237 mark, and so they created kind of this flagging pattern from that action towards the end of the day, where they did everything they could to try to get this below 237, but unfortunately for them, it didn't work out. Unfortunately for us, we had a slightly higher price in the stock, but it is getting to that point where this is going to be, we've been pushing up against 240. We've seen it 4 to 5 times, depending on the time frame that you're looking at, but we really want to see a decisive close above 240, and that will give us a good sign that we might be in a new uptrend in a short-term time frame. That would be really great to see next week. Now, next Thursday, we're going to have PCE come in, but I have a little note we can talk about there when we get over to the browser and look at some tweets or some X posts per se. Now, looking at this pattern, first thing I want to note that we didn't make a new low, obviously, but we're also respecting during intraday trading. We're respecting that 235 and kind of bouncing off it. And what this needs to look like come next week. Now, to be fair, you could see movement like this where it comes off, and because this would still be in that kind of context, kind of a bullish ascending triangle context. If you see it still retrace, come back up again, and you can get pretty tight on this. This can contract really, really tight, but most triangles don't really do that. They actually just roughly form a shape of an ascending triangle just based off the lower lows and that kind of equal high. So it could look like that, but what we want to see is a small breakout to 240. And I want to see it come over just 240 a little bit and get a lot of people excited, like, oh, we finally made it. Now, this could be an intraday thing, most likely, but I like to see a 240 and a peak above it slightly. I want it to come back down, and I want it to bounce off 238, 239. So I want it to come back up, and that would be now our kind of that would be the bullish breakout. Now, we talked about that in these blue lines here, but those aren't really as relevant anymore because I was hoping that would be like an earlier in the week type of thing where we came off that same level and bounced back off. But maybe this will be something that happens next week. So we clear that drawing out. We don't need this drawing anymore, because if we make a lower low based off one of these levels, which would be the 230 or the 231 area, if we make new lows there, I won't be too excited about Tesla breaking out of this triangle anytime soon, because maybe most likely that lower low comes from fear or de-risking for PC inflation report next week, or some other news event that might happen, be it like China, or be it some other Elon related news story. And there's always something going on with people trying to do a hit piece on Tesla, Elon. We know that today that the DOJ, or is it today or yesterday? Maybe yesterday, the DOJ was wanting to sue SpaceX for not hiring refugees and asylees, people essentially coming into America claiming asylum. Obviously, that doesn't make any sense because SpaceX is a defense company working with the Department of Defense and the government, and having non-U.S. citizens work at the company is just not possible based off ITAR rules. So there's always something going on. So everyone's trying to keep Elon down, which in turn tries to keep his companies down. So that's one of the X factors that we have to deal with on a constant basis when it comes to Tesla. So let's clean up the chart a little bit because the levels are fine. It's cool. We know them. We don't really need to see them. What we want to break out. Maybe you can do a slight intraday test, or even, maybe gap down the next day to 239, 238 and kind of move off it. And it doesn't have to be a strong move. We just need to start making higher highs and higher lows. And I think that would be perfectly fine. Now, let's go over to the browser real quick, and we'll talk about some little tidbits of news today. There hasn't been much relevant Tesla news when it comes to affecting price action, but it was always fun to see Dan Ives go on CNBC or do an article and talk about his bullish views on Tesla. So Wedbush's Dan Ives, he was on CNBC today, I believe. Was it last call? But he was on CNBC, but he also posted on Twitter talking about the bullish catalyst for, or what his models show as the reason for Tesla being much higher in valuation in the future. And that's going to be, he believes the supercharger network would be a $10 to $20 billion business by 2030. And the reality is like he's maybe basing this off of, other supercharger companies or what have you, but we don't really know what the agreements are when it comes to, the adoption of NACS and other companies and other manufacturers using the supercharger network. We don't know if there's a kickback involved. We don't know if there's a reduced rate. We don't know how much we are charging these. We don't know what the profit is really going to be for these people, and if we're charging the OEM manufacturer some type of nominal cost for them to adopt this program. But it's always good to see analysts go on to CNBC and talk talk the stock up a little bit, because the typical situation is someone goes on CNBC or Bloomberg or even Yahoo Finance and just shits on Tesla all day long. And that gets really tiresome because, there is that narrative that's being pushed by those, major media entities that, it just sucks because, you feel like there's no one to answer these claims that there's no EV demand or that Tesla's margins are contracting. Like that second story, I wish someone would actually go on and talk about, maybe that, there is, with discounts to the car price, that even with the discounts, like we're still talking about, efficiencies in manufacturing, reduction of cost of goods. Like there's always like two sides to the story, but you always hear one side, and that really doesn't help the stock too much, because if you were to talk about an energy company on CNBC, they would defend that energy company to their blue in the face. But if it's Tesla, everyone's happy to shit all over it. But regardless, Dan's pretty bullish. He's always really bullish about tech in general. He likes all tech companies, Meta, Apple, but he does like Tesla. And he is really one of the only saving graces when it comes to the possible upside. Now, we know we had Powell's speech at Jackson Hole today. It was a short speech, and there is a little bit of tidbits that I do want to share with you just to help you understand what we're doing. And the gist of it is there's no real new information. Nick Timmeros here in this post, and Nick is called the Fed Whisperer because he has a lot of, I don't want to say insider insight on what the Fed is going to do, but he just has a really good understanding of the outlook that the Fed, and especially Powell, has on the economy. Nick went on to say, Powell said the same thing to Congress 3 months before this speech today, and said the same thing at a press conference 3 months before that. So we're talking about 6 months that he just has kind of the same idea. And the thing about Powell is that a lot of his speeches actually are almost word for word the same. FOMC speeches are almost word for word the same. I think the last one was only different by one sentence compared to the previous FOMC to that one. And the reason for that is because Powell he never wants to surprise the markets. Like, he's not here to be the catalyst to be like, whoops, something happened, oops, and the stock market crashes. I think he learned after the Jackson Hole speech of last year that, he looks back on the last year, and we were talking about, There's going to be pain in the economy, there's going to be pain in businesses. But yeah, there's elevated bankruptcies, and we're all suffering through inflation, higher costs of goods, especially when it comes to food and things like that. But if you look at the overall economy and you compare it to the rest of the world, America is doing better than everybody else. Everyone's talking about how big and how powerful, China's economy is. But look, they're basically going through 2008 great financial crisis, similar to what America did. If you look at Europe, almost every European country is in a recession. They have no energy independence. They rely on food imports to survive. You look at the market in America, and you can almost see our equity market as basically the direction of the flight of safety for people who can move money overseas into America. And we can give them higher yields on treasuries. We can give them more returns, especially for this year when it comes to equity. So Powell's looking at the last year and saying there really wasn't the pain that I thought we'd have to go through to get inflation down. I think he kind of learned his lesson about really, shocking the markets. And over the past couple months and over the past mostly the year, you've had a very predictable Fed. You kind of understand that if it's really plain as day, if inflation's a little hot, we're going to get a rate hike. If it's not, you can count on nothing happening. And for now, I think the Fed funds future rate bets are basically no hike in September and a 50-50 chance of a hike in November. So maybe we get one there, but depending on what we're seeing with inflation, we can maybe actually count that out. Now, let's continue with Nick Timros's comments. Nick says the more relevant question, because there's no interval of time over which the Fed has to bring inflation back down to that 2% target. How quickly and leisurely will officials manage the process? This is as opposed to a target change that's not in the cards. That could be the debate to watch, meaning that during the speech that Powell made sure he said it in plain just English. And he said, though, of course, he has said this over and over again during his speeches and testimony to the Senate and the House, that 2% will be a target. There's no flexibility on that for him unless he means 2.9% instead of 2.0%. But if that's not the case, 2% is his target. And number one, 2% is very arbitrary. But anyways, so Nick kind of is basically saying that, it's the same message. It's slightly hawkish in the sense that if the economy keeps growing, because if you look at the Fed Atlanta GDP now results, that's a 5.8, 5.9% GDP for the year. That's in their minds, the Fed's mind, it's a little too much growth, and the growth in itself could bring back inflation because it's giving more money to people. People will be spending more often. There's more money in the system, more money than they expect. But he also says something significant, a significant further drag. And that significant further drag would be, I think I have the full quote. Okay, so here's a quote from Delta One on X. In this post says, Fed's Powell may still be significant further drags from past hikes. So he's basically saying that there's a lagging effect, that other policy decisions haven't trickled down through the economy as of yet, because you're basically, and if you can kind of look at it in the lens of from the individual consumer, JP Morgan has said that we basically have run out of our savings, that all the savings that you would have had from cash injections, from COVID lockdowns and all that stimulus is basically gone for everyone in the country. And with that gone, what does that do to demand? What does that do to inflation readings in the near future? Maybe they come down even with slightly higher energy costs and very lackadaisical shelter inflation coming down. So it's possible that he's kind of leaving it open to a flexibility in the short term, meaning that the data that he's dependent on is going to be really just these inflation reports and trying to see if inflation is going to come down. Now, Nick says also the Fed, Jay Powell's word of the day is carefully. I think this is something you do want to notice, because it really is about that he wants to not push it too much. He's been getting a lot of heat from the government, through the Congress people and senators about how they're hurting their constituents with these rate hikes and high interest rates and higher for longer and what have you. So he wants to basically make you understand that he's considering how you are feeling in this economy. And when I say you, I mean an individual person. Now, breaking market news, which is Financial Juice on X, he also says we will proceed carefully on whether to hike again. He believes that though we're at a neutral rate when it comes to the policy, that restrictive policy could be, more restrictive policy might be appropriate. Inflation doesn't drop fast enough. He believes that real rates are actually positive. And what else does he say here? Persistent above trend growth could warrant tightening. And that means that if you keep seeing the economy growing in the face of these interest rates, and I think a couple Fed governors made the same kind of comment where they're very surprised how the individual consumer has fared in a year and a half of increased interest rates. But that could be just because we know we had some extra cash in aggregate. I'm not saying that you and me have extra cash. I wish I had more extra cash, but he's talking about there's other people that do, and maybe the rich people are running out of their money as it sees now. Now, this is something that's really interesting. So PCE hasn't come out, right? We know that PC inflation is coming out next week on Thursday. And Powell just randomly said this. I don't know if because he has the information already, did he just leak this to us right now? Because he says he sees July's PCE at 3.3% and core at 4.3%. Because if this is even just his estimation of what the inflation reading will be for next week, just based off trends or based off his modeling, if it's more wrong than his models, he's not going to look good if he's that wrong, right? And he's coming out in public into one of the most watched speeches in the year, and he's saying that he sees July's PCE headline at 3.3%, core at 4.3%. And I know some market participants see it the same as well, but this is the Fed chair saying this. So let's say it's a happy leak. That means core is going to be at 4.3. We already know. Then if that's the case, we're all prepared for it. It's not going higher than what was last month or something like that. So maybe this is a little bit of information that can really bring down the volatility next week. And we know that the VIX has a gap to close below, and that would mean if the VIX was to come down even more back into the 16 range, 15 range, maybe we can get some upward movement in the overall stock market. He does make mention about the tightness in the labor markets. He really needs to see a softer labor market because he doesn't understand how inflation will get lower from this point in any expedited way unless you see basically when they say softer labor markets, he means more unemployment. And now unemployment is currently at a record low. We do have a little bit of flexibility in that. But he also says getting inflation back to 2% likely requires below trend growth. So you want that GDP to come down a little bit, or just don't go above what it is now. No more 5.9, no more 6.0 for the rest of the year. He's of course, he wants to interject a little bit of hawkishness. He says, we are prepared to raise rates further if appropriate and to hold rates at restrictive levels and confident inflation is moving down sustainably to 2%. Now, what does this mean? So this basically means that he intends to hold rates at a restrictive level, yes, but if he feels that inflation will then move down to 2% on its own, we don't need to see 2% to start getting rate cuts, I believe. We don't need to see 2% to actually just bring these rates on down. He says housing services is going to come down. He made mention that he's seeing data on his side that housing inflation will come down, but he needs to see services, non-housing service inflation come down. He needs to see sustained progress on goods inflation. I think this is going to be easily done because we have deflation coming out of China. So if China's exporting their deflation to us, that means that they don't have demand on goods, and the only way for them to create demand on their goods that they're creating is to bring their price down. That means our prices come down and good inflation comes down. So this is his note about housing. Slowing rents points to a slowdown in housing inflation. They will continue to watch. So they want you to know that, yeah, they're seeing data on their end, that housing is coming in, and we're not really seeing it necessarily. But rent has been a real lagging indicator due to how rent works. and how they calculate in their models what housing inflation is. Like, I mean, it's just ridiculous how they calculate just inflation in general. But housing inflation, they'll call you up and be like, hey, you own a house? Cool. Okay. And just tell me, if you were to like move out of your house and rent your house out on the market, like what do you think you can get for it? And they're just basically just going off just your idea of what your home would cost a renter in a month's period. Like, and you don't even have time to like do research, and you're just like, okay, so if you wanted to rent your house out, what do you want for it? Like, what if you have your house paid free and clear compared to someone that has a mortgage on it? I mean, your idea of what you want for your rent is completely different than in those both scenarios, I believe. But anyways, the market wasn't scared with his speech. He used the same terminology he's been using. He's been saying the same things for months. So we were kind of scared about what was going to happen, and there was a lot of de-risking for this speech. You saw it today. You saw it yesterday. But then again, the markets bounced back. And in Tesla's situation, we look at it again. Tesla closed in the same kind of price area as it did earlier in this week. So that's not so bad. But if you look at the likes of, let's look at the S&P 500, and yeah, maybe they didn't close at the week's high. The week's high being yesterday at around 445. But definitely, at least they closed higher than, what, Monday? Let's see. So we closed higher than Monday, but not on Tuesday. So it did okay. But what's really important to see here is we didn't make a new low on the S&P 500. As you can see that. Let's look at the daily to see a bigger time frame. And what we're seeing on the bigger time frame, the S&P 500, is the infamous head and shoulders pattern. We could be seeing a bear flag situation, right? We can see that. Or we can just be seeing a slow retracement back up. And this could just be a simple, healthy pullback. And if we can recapture these moving averages, especially if we can capture the, the 50, that would be really nice. And it rejected pretty hard off it, to be honest. And you can see that in this candle. But we still closed green for the week. So let's look at rates through TLT. We're looking at, this is the long bond, and we kind of drew this pattern out. I think we got a good level here that, we figured that it's going to kind of consolidate here. Maybe it dips down a little bit. If it does dip down into the beginning of September, that could be a sign of a pullback in the market as well. So hopefully we don't see that. Or you can just kind of linger around here, wait for inflation to come out next Thursday, and this can bounce back up if an inflation reading comes out really, really well. 10-year yields, we drew this head and shoulders pattern. So far, it's kind of following that. So this is on the small, shorter time frame, going back to the 10th of this month. But anyways, this could play out, so we can keep watching that. It seems to be following so far, and that would be really nice to see yields come back down on the 10-year, which would be really, really good for the market. Let's look at the VIX. So the VIX is at 15.67. Okay, cool. If we can drop down back to like 14, that would be really, really good for the markets. The VIX usually fills all its gaps all the time eventually. So this consolidation can simply just be a distribution pattern. You can see this kind of being the peak of the distribution if you believe in Wyckoff, and didn't make a higher high necessarily. And so maybe we can make a lower low, maybe early next week, get ourselves back down to around 15 flat and break into the 14s as we get closer to PCE on Thursday. NVIDIA is not doing so hot. Let's look at NVIDIA on a smaller time frame. And let's look at NVIDIA compared to Tesla. We'll just compare Tesla to see how we're performing. And you can see there's been a slight outperformance over the past couple of days and closing better over the last, looks like, 6 days. So Tesla's doing good compared to NVIDIA. What's the deal with NVIDIA? NVIDIA had a great report, but there's some question about is this going to be a sustainable growth? I think a lot of analysts believe that this is obviously going to be sustainable growth, but a lot of people don't really want to be in the name because there's the upside maybe is limited to compared to what? Like maybe Target, maybe to Disney, maybe to Nike. Consumer retail and consumer discretionary might have a little bit more upside than NVIDIA in the short term. Like maybe NVIDIA will be a slow grind up, like kind of did, well, last quarter it wasn't a quick grind up, but it did eventually make some pretty nice highs over the course of like 2 months. But for now, maybe they see a rotation into something else because there's been a lot of weakness in the market for those retail-like names. And you can kind of see that. We can kind of compare that. And there's Target. We can see what Target looks like. We can see the likes of Disney. We can see Nike. And if you think NVIDIA did bad, they've been doing not so great at all. And as you can see, as we draw the time frame out, there's just been an underperformance. So maybe this is the time to rotate into some depressed names, get out of NVIDIA, get out of tech, get into some really boring names, perhaps. Because if inflation is going to go down, there's names that will really benefit from rates going back to normal, especially things like Tesla, things like these stocks. Because NVIDIA is not really sensitive to rates. Like they're going to do just fine in a high rate environment because the people spending money with NVIDIA are not individual customers like you and me. All they care about is, business to business transactions like Apple, no, not Apple, but, like Google buying $3 billion worth of chips from NVIDIA or something like that. We're like, if you're going to buy one graphics card, yeah, they like it, they need it, and they need to get rid of a lot of inventory when it comes to graphics cards, but no one really cares about that. So Tesla had a decent week, guys. So I think we need to just be happy, take what we can get, and hope that we can keep pressing against the 240 strike and maybe break through early next week. I want to see a breakthrough before inflation. So set us up for some disappointment. If inflation is really, really bad, I would say maybe around what levels do we want to look for? Gap fills, basically. Let's just fill some gaps. Like, why not? Like, there's one here at, what is this going to be, 246? Somewhere around 242. That would be really nice to see. Let's just change these colors real quick so you don't get too confused. But I'd like to see some gap fills coming into next week. And that just really depends if we can survive any bad news. But we also had some good news out of China, though. I can kind of see if we can bring that up. Let me go back to the browser and switch back to, I think I retweeted one post. How do I get back to my profile here? Oh, there you go. Sorry. And this was from Breaking Market News, again, Financial Juice. And he was mentioning that overnight, China issues rules to ease mortgage for some home buyers. Basically, new policies when it comes to maybe discounted rates, when it comes to people who only own one home, who's going to buy their first home. And they're essentially just trying to, and we kind of, some parts of the market, and even myself, were really wondering if they would actually help the individual consumer. But their real estate sector was hurting really, really bad. Really, really bad. And I like to see them maybe, the property values in some of these existing mortgages are so out of whack, meaning that the value of the home that they just purchased is so much further below what they paid for. And it's kind of like if you bought a home in 2006 in America, and in just like 1.5 years later, that home is 40% less in value, you're going to ask yourself, like, why should I pay this? Like, why would I want to pay 40% more for a home, which equals a very high monthly payment? I'd rather just go freaking bankrupt. So maybe that we're seeing the first signs of them actually giving, just the average everyday person in China a little bit of relief, and not just trying to salvage some of their large financial institutions when it comes to this. They're trying to go for a very, how do I say this, like very safe way in rescuing their economy, meaning just trying to keep things from going really, really bad and just accepting kind of bad for as long as they could. But I just don't think you want to put their consumers through what is very like a totalitarian regime and then just make them suffer, because I think that creates problems for an authoritarian government like the one that is in China. So anyways, yeah, I think that's pretty much it. let's try to survive the weekend, maybe get a little bit more China stimulus on Sunday night, maybe get some positive news with Elon driving the Cybertruck not a Cybertruck FSD, but driving the FSD beta that he has, his version. That'd be really cool. He mentioned that he wanted to do that on X even just earlier this week, and he moved it over to Friday, but I'm not sure if that was done as of yet, but you can take a look at it this weekend and see if he did. We're seeing a lot of Cybertruck pictures come out from the factory, from Elon. Hopefully we can get a clear idea of when that delivery event is going to be, because but Tesla put out that redeemable thing in the point store where you can spend 30,000 points, get an invitation to a Cybertruck handover event. That'll be really cool if we can get some more dates about that, and I think that'll help. I actually think that would be a catalyst to help move the stock up even further and then hopefully keep outperforming NVIDIA. All right, guys. Thanks so much. Have a good weekend. Bye.